be talking about whether to incorporate your business or not. William Secord owns a proprietorship that makes organic foods known as Secord Restaurant. William only needs $45,000 before taxes for living expenses and invests his excess income into public corporations. He is currently taxed at the highest tax rate and is wondering if he should incorporate Secord Restaurant or not. First, we will talk about the advantages of incorporation. One of the biggest advantages is the limited liability to shareholders. This means that shareholder liability is usually limited to the amount that they have invested into the corporation. Also, the shareholders' personal assets will not be at risk in the case of a lawsuit against the company. For example, if the corporation goes bankrupt, a shareholder will not lose more than his or her investment unless the shareholder had provided personal guarantees of the corporation's debt. Another advantage of incorporation is the greater access to capital in comparison to other forms of business. They can issue shares or bonds in addition to loans and investments from owners. Loans to corporations are also seen as less risky than loans given to other forms of business. William is currently taxed at the highest marginal tax rate. If he incorporates, business income will no longer be included in his personal taxable income. It will be taxed at the corporate level, which means his taxable income will be reduced by a significant amount. This is because he can choose his compensation in the form of a salary, dividends, or bonus to minimize his personal tax liability. The corporation has many deductions available to it in comparison to an individual. The small business deduction is offered to all CCPCs. A CCPC is a Canadian corporation that is not controlled by public corporations or non-residents. So if you are a Canadian citizen and you incorporate your business federally or provincially, the company will be a CCPC. Since Secord Restaurant would be incorporated in Canada, it would qualify as a CCPC and be eligible for the small business deduction. It will be subject to a lower corporate tax rate on the first $500,000 of active business income. Starting with a general rate of 38%, the corporation will be subject to the abatement, which reduces the rate by 10%, as well as a 17% small business deduction, totaling 15.5% total tax rate. Now we will look at the main disadvantages of incorporation. One of the most significant disadvantages of incorporating is that it is timely and costly to start up. This is due to the fact that incorporation has a more complex legal structure. Additional startup fees may also be incurred, including accounting and legal costs. In addition, there is a large amount of paperwork, such as articles of incorporation, which will be time-consuming. Secondly, there will be increased formalities for the corporation. The corporation will need to file certain documents, such as an annual return, articles of incorporation as mentioned before, notices of any changes in the board of directors or in the address of the registered office. It will also need to maintain certain specified corporate records and register in any province or territory where it carries on business. There are also more complex structures that include a board of directors, shareholders, and officers. Lastly, William's main concern was the possibility of double taxation that he read about in the newspaper. We will discuss the concept of integration, which will ensure William that he is not being double taxed. Integration refers to the avoidance of double taxation of income earned in the corporation while also preventing tax deferral. Since Secord Restaurant is eligible for a small business deduction, it allows a tax deferral of 9 to 31% on taxable active business income, where the profits are reinvested rather than distributed as dividends. However, once income is distributed through taxable dividends, a refundable portion is provided to the corporation to minimize double tax effect. This would ideally reduce the corporate tax rate to 15.3%, which would eliminate double tax. Although integration is not perfect, it effectively eliminates double taxation at a combined corporate tax rate. As a CPA who passed the CFE exam with flying colors, we advise William to incorporate after the analysis of the advantages and disadvantages, as it will be beneficial to him in the long run. Thank you for watching.